depreciated if you revalue it.
Okay. So, I mean, the general rule apply. Hang on, I'm recording. Yeah. Previous one was revaluation of land. Okay, this is revaluation in general. Revaluation in general. Look, one of the things about AASB 116 is whenever you change the value of an asset for whatever reason, revaluation or impairment, in fact, even if you don't change the value of an asset, you need to think about depreciation every year. Right, so every year you need to think, is the depreciation still right? You need to reassess the pattern and the length of time. Because you might have started depreciating an asset, you thought it was going to have 5 years, and then suddenly you're 3 years in and you realise, oh, it's still got another 4 years to go. Because you're only making estimates of useful life, right? And those estimates will change as you go through time. Right, so you have to do that. We never do it when we teach it, but you have to do that in real life. And I suspect a lot of businesses don't do it either. Okay, so if you know that you've got to think about depreciation again, all the time anyway, if you change the value of an asset, you've also got to think about it again, right? So if you revalue an asset upwards, you need to think about, has its useful life changed? Well, hang on, it's got more value, so maybe you're going to get more service. Does that mean you're going to get more service each year, or does it mean you're going to get more years? Right, so you need to ask those questions.
What do you mean more service?
Well, why do you revalue upwards? Because the asset's bigger. What does the asset being bigger means? It means it's going to give you more benefits in future. So that could mean it's going to last the same amount of time but give you more benefits each year, or it's going to give you the same benefits each year but last longer.
That's called revaluation.
Well, I mean, why do you revalue? Because you're going to get more benefits out of the asset.
I thought the revalue means revalue the market value, but it has nothing to do with depreciation.
Well, it does, but the point is, if you've got an asset that depreciates, what you're doing when you value an asset, when you record an asset is just a prepaid expense.
Yeah.
Right? If I've got a car and I revalue it, it means that if my car's $100 and it's going to last for 5 years, the cost of using that car each year is $20. If I've now got a car worth $200, it's still going to last 5 years, and the cost of using the car each year is, or using up that asset, $40 a year. So, yes, the revaluation is about market value, but since every asset except for land gets used up, you have to, eventually the asset's got to go to expense. Right. Okay. So the general rule was pretty simple. If you revalue an asset, you've got to recalculate depreciation for the remaining years.
How do you recalculate?
How do you normally calculate depreciation? You work out
cost minus the residual value and divided by the useful years.
Yeah, if you're doing straight line, yeah, that's what you do. So you just do it again.
How do you? This example.
Have you got an example? We'll work through it.
Where is it? Is that the one? A building is purchased on 2009, July 1st for 500,000.
Hang on, let me write it down. Building is purchased when? 1st July?
1st July 2009 for 500k.
Okay.
It has an estimated useful life of 10 years.
Yep.
Zero residue.
Hang on, 10 years, so that means it's going to last until 30th of June 2019. Okay, yep.
And then zero residual value.
Yep.
And is depreciated using the straight line method.
Okay, that's good.
The company elects to use the revaluation method and revalue the building on a regular basis every 2 years, starting from June 30th, 2010.
Hang on,
but
that's after 1 year.
Hang on, why is it July 1st to... Yeah, it's 1 year.
Okay.
Started from... Okay, so on June 30th, 2010, the company estimated the fair value of the building to be 540k.
Right.
What does that mean? 30th June 2012, the company estimated the fair value of the building to be 280.
Hang on. Okay. Oh, maybe it says 1. It should be on 30th June 2012.
Oh, it's on. Okay.
Yeah. Fair value equals what?
280k.
Right.
There is no change in depreciation method estimated of useful life or residual value.
Okay.
Let's complete all journal entries for this building from 1st July 2009 to 30th June 2013.
Okay. All right. So first thing, you buy the asset. So
how come there are nine journals altogether?
because there's a whole bunch of depreciation and stuff.
Right. Yeah,
Okay, so debit building 500, credit cash 500. Nice.
Oh yeah, when you buy it.
Okay, yeah.
Okay.
All right, so that's the first one. Now, in the first year, 1st of July 2009 to 30th June 2010, what's the only thing that happens? Depreciation.
So it's 13th June 2010. It's only 1 year, right?
Right.
Okay, yeah. So debit depreciation expense.
Because even though you're going to revalue it, you've still got depreciation for the year.
Okay.
So your depreciation is going to be 50, right? Divided by 10 years.
Oh yeah.
And credit accumulated depreciation. 50,
Yeah.
Right.
50. Yeah. 50.
Okay.
Yeah.
So that's your depreciation for the year, right? Then at the end of that year, you revalue it. So what's the asset look like now? It's got building 500, and it's got accumulated depreciation of 50. So its net amount is 450, right? Right. And now you're going to revalue it to 540. So you're going to revalue it from 450 to 540. You're going to revalue it up by 90.
Hang on. So it's 450 now, and when you revalue, so it's upwards, so going to revaluation surplus,
Yeah.
right?
Yeah.
90. Okay. Yeah.
But one thing you have to remember, there are two ways of revaluing. We don't do the silly one, we do the normal. Don't worry about the silly one, it's called the gross method. The net method, what we do is, before we revalue, we transfer the accumulated depreciation to the asset. So instead of...
Say it again, you transfer what?
You transfer the accumulated depreciation to the asset. So instead of writing it asset 500 minus accumulated depreciation 540 equals 450, you want to write it as asset 450 minus accumulated depreciation 0 equals 450. Right? We haven't changed it, we've just changed the... Look, think about it this way. After you revalue an asset, the asset has to look new. So what's a new asset look like? It's got no accumulated depreciation. Okay. Right? That's just the rule you have. It's a silly rule, but the other rule is even sillier. So this is...
So how many useful years does it have now?
The years haven't changed.
Still 9 years?
Yeah, still 9. But we're still doing the revaluation, right? So we want to firstly restate the asset from 500 minus 50 equals 450 to 450 minus 0 equals 450. Okay. It's not logical. This is one you have to remember. Okay. Right? So to restate it, so the first part of... there are 3 things you need to remember for revaluation. 1, make sure your depreciation is up to date. 2, transfer accumulated depreciation to the asset. So debit accumulated depreciation, credit the building for 50. Right. So after you have done this entry...
No, we did this before, right? Debit the depreciation expense and the credit...
No, and now we're undoing the accumulated depreciation, moving it to the building. So we're rewriting the asset from 500 minus 50 equals 450 to 450 minus 0 equals 450. That's all we've done it. Right, so that's the second step. Close off the accumulated depreciation.
But the thing is, from this journal, it just write each other off.
Yeah.
So the building is still 500 then.
No, it's not.
It's 50, right? Depreciation.
Which bits cancel? This cancels against this. This doesn't cancel. This doesn't cancel.
Oh,
the depreciation still... Yeah.
Oh, okay.
All right, so what we now have is building of 450 minus accumulated depreciation of 0 gives you 450. Now we want to revalue it.
That's the depreciation expense accumulated, and now you reverse it, accumulated and buildings.
All I'm doing is I'm doing this. I'm reformatting the way it's set out on the balance sheet.
Accumulated 15.
We've got a lot to get through. You can look at this later. This is one you've got to remember.
I don't understand. Why do we do that?
There's no logic. The standard...
No. So what is this for?
Well, to change this into this.
Okay. But where's 450 then? How come it's 50?
450 is just the difference between these two numbers.
Okay.
That's the carrying amount of... That's the amount that hasn't been depreciated. Okay. The third part of revaluation is actually doing the revaluation itself. Right? So we want to get it from 450 to 540. Right? So the building's going to be 540. The accumulated depreciation, of course, is 0. Right? So we want to get the building up by 90. So debit building by 90. Credit what?
Revaluation reserve.
Revaluation surplus, yep, by 90, and there you are, the building's revalued. So you've done, so Journal A was the purchase, Journal B was the depreciation, Journal C and D close off accumulated depreciation and do the reval. That was the reval.
Actually have that. So the first one, 500, reconcile with depreciation.
Of course, it's all the same as mine.
Yeah. So this one is a 50-50, right?
Yep.
So how do they explain the write down the asset till
It's carrying.
its carrying amount? What does that mean?
That just means rearrange the asset. Change that into that. Change 500 minus 50 into 450 minus 0.
Okay.
Look, it's the same journal entry as I've done.
Yeah,
So,
yeah,
okay? Right, so that's the first year. Okay, what's the first thing that's going to happen in the second year? Now we're talking about 30th June 2011.
This is...
No, that's 2 years later.
Oh, so
What's
that's 11.
Yeah, so what's going to happen?
Just depreciate.
Okay, so debit, depreciation,
50.
credit, why 50?
I saw 50 every year.
How do you get that? It's now 540 and it's got 9 years left. 540 divided by 9 is not 50. Right, so it's 60. Okay, so there's 60 there. So journal entry E is depreciation of the second year.
Oh, you do like this?
Yeah. Right. So what's the asset look like now? It now looks like building 540, accumulated depreciation 60, carrying amount is 480.
Okay.
Right.
Yeah,
Okay, so that's that year. Now the next year, F. What's the first thing we need to do?
Accumulate. Depreciate.
Depreciate again. So F. And because nothing's changed, it's going to be 60. Yeah. Right.
So 420.
Yep. So now the building is 540. The accumulated depreciation is 120. So the carrying amount is...
building should be 480 and here is 20.
Why 480?
Why 540? 480 was
Well, 540. We revalued it to 540.
But last year was 480, so why is not
Well,
480
where's it 480?
Here.
No, that's a subtotal. That's not an account. This is an account. This has 540. Have you changed the building account anywhere? Have you changed the building account anywhere? No. Right, so why would it be anything else? It's still 540. If you haven't changed it, why would it be anything else?
But don't we calculate it every year in the balance sheet? No?
You don't change the building, you change accumulated depreciation. Look, which accounts are affected here? Depreciation and accumulated depreciation. So this account changes. Why would this one change? There's no journal entry for it.
Sorry.
Okay. Alright, so the net, so building's 540, accumulated depreciation 120, the net amount is 420. Okay. So that gets you to the end, to 30th of June 2012.
Okay.
Now, what's the last thing we need to reval? Okay. So the building's being carried at 420, we want to revalue it down to 280. Okay. So we want to get it to 280. Yeah. Right.
But before it was increased, right?
Yeah.
So we should go.
We need to work out how much we're reversing. Okay. First thing to do, we need to transfer the accumulated depreciation into the building. Right? So we want to make the asset look like not 540 minus 120 equals 420, but 420 minus 0 equals 420. Right? Same as we did here.
That's only happened when there's a revaluation.
Yeah. Before you do the revaluation, you've got to close off the accumulated depreciation. Or they call it write down, but close off. Okay. So the first one you do for the reval, right? So there's always two entries for the reval. You've done the depreciation. Close off accumulated depreciation, do the reval. So first one, close off accumulated depreciation, entry G. So debit accumulated depreciation 120, credit the building 120. Right, so it's now building 420, accumulated depreciation 0, net amount 420. Okay, so now you want to revalue it to 280. So how much is the land going to? So how much is the building going to go down by?
420 and 280, so
140.
140.
Okay, so you're going to credit the building 140. So there's going to be entry H. Now the thing is,
Two parts.
Yeah, two parts. So you've got to work out how much is reversing and how much is new. Well, what did you do before? You revalued upwards by 90.
So downwards 90.
Yeah, so that's why you've always got to keep
90.
track of how much you've revalued so far.
Okay.
So debit
Revaluation,
revaluation surplus 90, because that reverses the old one.
and then the 50.
Yeah, and then the 50 is new, so it goes to loss on revaluation. Is that right, what they've got? It should be.
Yeah.
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 Right. Now they've got one more journal entry. So what's the question say? What do we need to do journal entries until?
Last year, recording until June 30th.
Of what year?
2013. Sorry.
Okay, so what we've got, so that was
you
G and
just
H.
go the depreciation.
Yeah, so now we're going to take it from two, well,
280.
look about how many years? 1, 2, 3. So there's 7 years left. Year 1, year 2, year 3. So I've got 7 years left, 280.
40.
Okay, 40. So journal entry I is going to be depreciation for that year, debit depreciation, credit accumulated depreciation, 40, 40. So after that, the asset is now going to look at 280 building minus accumulated depreciation of 40, so its carrying amount is 240. I think generally when you do these sort of questions, I know why you got mucked up, but after you've done all the entries, show yourself what the asset looks like on the balance sheet. Remember, this 450 there, that's only a subtotal. It's not an account. The accounts are building and accumulated depreciation. They're the things. So you can't say this is... The only way these can change is if you do a journal entry to them.
Yeah, no joke. But just here, this bit, I don't know how to explain it to the 450. Where do you... Instead of write down...
There's no logic. The standard requires it. That's the only reason. And because it's not sensible in any way, all I just say is you've got to remember it. So the way I remember it is after revaluation, an asset must always look new. In other words, it's got no accumulated depreciation.
Okay.
And eventually you'll remember that's what you meant to do. But yeah.
Write down the asset.
Yeah. Because there's no logic. Because, I mean, the carrying amount's 450 before you did it, and it's 450 after you did it. So there's no logic to it. It's just the standard requires it.
Okay, alright. You look at yours and I have a look at it.
Okay, hang on.